Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. Just after the close on December 4th. More of the same. Index is very, very strong. What was the tell on this move? There's always tells or multiple tells to market action. Go back the last 90 days. What have we been really focused on? Expanding breadth. More sectors, more industries getting into the game. Russell 2000, that's your tell. Last 90 days, Russell 2000 up 3x the S&P 500. S&P 500, respectable 7% return over the last 90 days. Russell 2000, 22% return. As you saw capital coming into this market, it was looking for areas that hadn't participated previously. Seeing very nice strength out of small caps, mid caps as well. But this daily bid and weekly bid really goes to the heart of how poorly positioned large baskets of capital were coming into this election. Again, very difficult to fight headlines. One of the toughest things we do day to day, week to week, month to month here in managing money for clients is to try to ignore headlines, or at least look at what the reaction to them is, not what they are. COVID, COVID, COVID. Politics, politics, politics. What happens if Biden gets in? What happens if Trump gets in? All of these things cause money to leave the market. Think back to that chart we shared 4 or 5 weeks ago, where iShares, largest ETF sponsor in the country, said in September less than 5% of their inflows went into equities. That's a paltry amount in terms of flow. Just went to show how, let's not say nervous people were, but cautious with some of these headlines and events ahead of us. So now we're seeing the flow back into the market. We want to be careful here because we are seeing some rich sentiment readings. But I want to share a chart with you that just shows how strong this breadth has been. The chart you're looking at right now is the New York Stock Exchange High-Low Index. What the High-Low Index does is take a look at the number of stocks in the New York Stock Exchange making highs versus the number of stocks making highs and lows. So out of every stock that's making a high or a low in the New York Stock Exchange over a moving average over a week, what percent were highs? What percent were making highs? 97% over the recent week. That's only the 14th time in the last 40 years. This is an indicator that's been around forever. Been using this indicator for 25 years. My initial thought on that indicator is when we get to 97, that might mean we have to tap on the brakes, that there's a cliff coming around the corner. It was interesting, Dorsey Wright put out this chart this week. Look at the performance when you get that kind of breadth in the market, as evidenced by the Russell 2000 performance. When we go 6 months out, you have dynamite performance. Very few drawdowns. They're there. But in terms of increasing breadth, very difficult to turn that around. So momentum can run on a weekly basis back and forth. Breadth a little stickier. So let's keep an eye on this going forward. In terms of interest rates, you saw more confidence in the economy. Obviously, that's partly due to the vaccine. Tremendous news. I've mentioned here before this messenger RNA work that's being done in the scientific community on the back of technology, on the back of the semiconductors that allow them to do this, is going to be life-changing for a lot of people. That may be 5, 10, 20 years down the road, but fantastic science. Do yourselves a favor and do some research into that. I think you'll enjoy it. But the vaccine and that loose Fed policy has finally started to get us to see rates coming up. We finished the week off about 96, 97 basis points on the 10-year. May not sound like a heck of a lot. Don't forget, 4 or 5 months ago, we're at 50, 55 basis points. So there's some confidence that the economy can get around the corner, can resume the strength we saw pre-COVID, and in terms of capital coming into the equity markets, that and the bond market action gives us some confidence coming into the new year. Remember the key, we don't get too high, we don't get too low. We want to have reasonable expectations, have reasonable levels where we want to get involved. Have a great weekend. See you next week.
Good afternoon, it's John Mousseau. I am the President and CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon, December 4th. Bond market, yields higher this week. 10-year bond yield basically went from 84 to 97 basis points, up 13 ticks. 30-year bond went from 157 to 174, up 17 ticks in yield. And about 7 of those ticks were today. Why was that? We saw a non-farms payroll increase this week of less than expected, 225 on jobs versus expectations of 450. We know that those November numbers were bad because we saw the increase in COVID in many places. So it's not that surprising it was below expectations. What was surprising was the bond market reaction to that, sending bond prices lower and yields higher. And part of that is baked into the fact that from the bond market's perspective, COVID has gone from being an unknown to a known. And what do we know? We know a vaccine is around the corner. We know with a jobs number like that today, we will probably get a stimulus bill out of Congress that will mean further growth, more spending, basically economic growth heading to a higher plane. That's the way the bond market reacted today. Munis, unchanged for the week. And so now the yield ratios between munis and treasuries are down well below 1%, about basically 80% on a 30-year AAA bond and about 75% on a 10-year AAA bond. Obviously, other types of bonds yielding more. However, that speaks to the fact that in the muni world, the market is already discounting the fact that it's going to be winding down very soon. Supply's picked up a little bit, but it'll be gone in a couple of weeks, and we have 2 big months of reinvestment, December and January, ahead of us. One more thing. When you look at the future, it is looking more and more like we're probably going to have a split government, Republican Senate, Democratic White House. So the market is feeling pretty good that with divided government, the status quo will probably be what you'll see. Probably some marginally higher tax rates, but that will probably be it. We look forward next week. We're going to see CPI and PPI numbers, very important for the market. One thing that I would like to point out to you is that if you look at our website, we put out a piece this week and we called it the Cumberland State of Despair Index, where we combine both the COVID infection rates in states with their unemployment rates to get a better feel of how states are faring and not only the economic cost but the social cost of this awful virus. So we ask you to take a look at that. With that, we wish you a very good weekend, and we will see you next week.